a moment in your bones when the fire takes over. In your bones when it's running, fire takes over. As the battle gets closer, as the battle gets closer, they can say what they want now. 'Cause we'll be screaming out, we can be heroes everywhere we go. We can have all that we ever want. Swinging like Ali, rocking out bodies, standing on top like a champion. Keep your silver, give me that gold. You'll remember when I say we can be heroes everywhere we go. Keeping us down is impossible, 'cause we're unstoppable. Oh, we're unstoppable. We're unstoppable. Every spotlight, every soundbite, everybody who gave up is just a fuel for wanting him more than anybody against us. They can say what they want now, 'cause we'll be screaming now. We can be heroes everywhere we go. We can have all that we ever want. Swinging like Ali.
All right, we're going to give just a minute for people to get in here. Let's see what my delay is tonight.
We can be heroes everywhere we go. We can have all that we ever want. Swinging like
Looks like about 5 seconds.
standing on top like a champion. Keep your silver, give me that gold. You'll remember when I say we can be heroes everywhere we go. Keeping us down is impossible. We're unstoppable. Oh, we're unstoppable. We're unstoppable. We're unstoppable. We're unstoppable. We're unstoppable. We're unstoppable.
All righty, let's get started. I hope everybody's doing well tonight. I am Marziti, your host, and this is part 2, Intro to Price Analysis with Strategies. And as I've said before, this is a 4-part series going in rotation on Tuesday and Thursday nights. Let's see. Of course, we have the legal disclaimers here. This is my presentation. I'm not a financial advisor. It's for educational purposes educational purposes only. I am only a member of the Bullish Bears community. I am not compensated in any way for doing this. My presentation here does not necessarily reflect their opinions. You are responsible for your own trades, and you're welcome to copy and redistribute this video as much as you want, so long as author is given credit as due. So tonight, we are going to talk about, well, first of all, let me just make sure, can somebody give me in the chat here, because I've got this silly 5-second delay thing going on again. Am I coming through? Can you hear me? Okay, let me just hear from you guys there to know that the audio is coming through. Yes, thank you, Josh. All righty. Let's move on here. We're going to start tonight with what we call floor pivot points. Now, floor pivot points have absolutely no mathematical basis whatsoever. They're not measured moves. They're not regressions. They're not supply and demand. They're nothing. They are simply tradition. We kind of have to go back in time, back into the 60s and the 70s and the 80s, when people didn't have computers so much to chart all this kind of stuff out and do all these kind of measured move things we'll talk about tonight. So the trade, and back then you would have hundreds of people, what we'd call in the pit or on the floor there at the New York Stock Exchange, and they would scream out what their orders were to buy or to sell, and some guy stood up on a platform up there and would hear them and would take their orders and so on and so on, kind of like at an auction. If you've ever been to an auction and they give you a card with a number on it, and if you want to buy, you hold up your card and they see your number. But we didn't have a lot of the technology to measure these moves and so much so easily done. And there's literally stories of people that would talk about they would subscribe to their broker. The broker would have a service that the broker would mail them actually charts with technical analysis on it. Because like I say, the computers just weren't there yet to do this. So the people on the floor traders came up with they all kind of agreed that they came up with this little back of the napkin mathematics system that they called pivot points. And since other people have got different types of pivot points, we're going to put floor pivot points in there so that everybody understands what we're talking about. But if you go into your software and you try to add it, it's just simply called pivot points. And so what they did, they came up with formulas such as yesterday's high, plus yesterday's close, plus yesterday's low. And they would divide that by 3. And that would be, let's say, this line right here maybe. And that was a pivot point. And then they had some other mathematical things where they may say that high plus low divided by 2 plus blah, 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 or whatever. But at any rate, they were just a series of simple, easy to calculate math, kind of things that you could do on a piece of paper and a pencil. And they would come at this line, and then this line, this line, this line, and this line, let's say. Again, this is all pre-technology kind of stuff. So they all, as a group, agreed that this is the way that pivot points would work. And so they became target numbers. Well, needless to say, in today's computerized world, we don't need these kind of things, but they are still very commonly used because of tradition. And we're going to find that a lot of things are done by tradition. For example, the New York Stock Exchange hours, 9:30 a.m. to 4 p.m. Eastern Time. Even though the global economy and the internet and stuff like that makes trading, 24 hours a day kind of thing, but it's still tradition. And so there are still a lot of things that happen in tradition. So let's take a look at these pivot points real quick. We had this major sell-off candle right here, and where did it come to? It stopped on a pivot point. And then they took it down, and where did it come to? Not quite, but, a pivot point. Then it comes back up, and it chops around on this pivot point. And then it goes up, and it didn't stall here. It kept on going up to this pivot point, chops around, comes back down. I don't particularly know. Well, actually, if you look at this little pullback here, we went up, pulled back, and went back up. That kind of represents an area of interest, and if we come over here, that's where this pullback over here occurred. But again, notice, chopping on that pivot point. We did kind of blast through this one, though this red candle right here did stop right on it. We came up to this one, down, pivot point, pivot point. So how do we use these? Well, we use them as targets. This is not, you don't necessarily say, well, did I go long or short here necessarily? This is a target, a destination. You say, well, is there a trade here? Well, if you ever listen to Jeremy's streams, he always talks about when you have a huge move, we often see a counter move to at least halfway back of that big move. Okay. So if we say we got this huge move down here, we could possibly take a long position here, targeting the halfway mark. That's a possibility, certainly. And in fact, here we see there's a pivot point kind of in the area. So the halfway point and the pivot point are kind of close. So I would have targeted that pivot point. Notice here on this candle here, see that green candle there? It pulled back roughly half, almost, maybe close, fairly close to halfway before it turned around. That doesn't always mean that it'll turn around. Sometimes it'll go halfway and just keep going. But this halfway thing is kind of a target. Obviously, we didn't quite make it here, but that's not so much the point of this slide. The point of this slide is to talk about these pivot points. Obviously, we did not see the halfback move here. So you'd have to say, well, where do you get into the trade? And the trade is actually, you see this here, this candle stops here, and we see this red candle, and that becomes my break point. So I'd actually would have gotten into this trade on this green candle. I've had a pretty heavy pullback, but then we would have gone and moved on. So anyway, that's just that halfback rule. As you can see, it happens a lot of times here. We moved half back, and sometimes we go half back and roll out of it. Sometimes we just plow through it. By the way, does anybody remember from last week what this is, or last Tuesday? What is this called right here? What is this region called right here? Does anybody remember? 3 letters. F, V, G, fair value gap. I got a 5-second delay apparently between me and you, so bear with me as we, so I kind of have to stretch things out a little bit. But anyway, so pivot points, old school legacy kind of concept, but you can see here in this chart that they made outstandingly good targets for places to go, because right here we've got 1, 2, 3, 4, 5 instances on this chart where the pivot points really nailed it. All right. So any questions on this here? I'll give a moment here as we talk about these here. If you've got anything, type them into the YouTube chat, and we'll see what's going on with that. Also, I'm watching the main chat over in the Bullish Bears community Discord. If you have any questions over there, you can type in over there just as well. Okay. Give that just a sec. Oop, Jeremy's talking to me. What has Jeremy got to say? I'm being watched by Jeremy. Oh no, this means I'm going to have to go through a peer review process tomorrow. Mic volume is a little low. Okay. How about I'll bring my mic just down closer to my mouth here. How's that sounding there, Jeremy? Is that a little better? Good, 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 good. Okay. Where are we? We are still down here. Let me get my YouTube page up here so that I can see if there are any questions going on there. All right, moving on. Here. Next, we're going to talk about what's called a consolidation breakout, or AKA, also known as, the box. There are 3 parts to a box. There is a high. There is a low. The significance of this high is this must be a significant high, as in, like this red candle's high would not count because it's being shadowed by a higher high fairly close to it. This high right here took out all these recent highs. So that high is significant. This low is significant because it took out all these kind of lows. You say, well, there's a low over here, but still this low took out a bunch of them. So there's part 1. We have a high, we have a low, and then we have a move at least 50% back into the box. This defines a range, a consolidation range. So we have this high, it came in, it made a high, it came back down, they tried to push it down, they couldn't push it down any further, and now they are consolidating right in this range here. And as they consolidate, eventually, this is like that whole idea of coiling the spring up so that it's going to just go crazy when we let it go. I don't know if any of you have ever done that trick of taking two pencils and wrapping a rubber band around them and then twisting one pencil like a propeller and winding up that rubber band, then just set it down on the table and we'll just watch it go crazy. Yes, okay, that's silly things we did before technology came along. Anyway, so what do we know about the box? Well, we generally are looking for two moves out of the box. The first is, where does it come? It typically will come 50% move at least out of the box. And we're going to talk about the breakout signals in a moment. But as you can see, when it did break out, it came to the 50% level of the box. This box here is the same of this box here. Okay. So that is target number one, is a half point move in the box. Target number two, of course, is the top of the box. So as Jeremy likes to say, we call this first box a measured move. So we would call this a half move. And then we would call the whole box, come back, I clicked my mouse, let's go here. The whole box would be a full move. So we got a half move and a whole move, rather. I said, let's call it whole move. Well, let's kind of follow this and see what happened. Eventually it broke out. It did hit the halfway part. It chopped around a little bit, and eventually it came and it took out, made a whole move. Now, if we look at real-time history, or whatever you want to call it, we find there's a much higher percentage of it at least hitting the halfway move, not as often doing a full move. But that halfway move is much more predictable. So let's talk about the breakout. There is something to be said. You could say, well, it's right here. Well, that's where it broke out, right? No. No. Why not? We will study what's called a liquidity grab later on. We will study that later on, but what I want you to realize is that there's a lot of people that have got orders out here that if they went short, their stops are sitting right up here. This candle could possibly be going for that. We'll talk a lot more about that later, so I'm not going to go into more detail about it. What I want to see is the breakout of the next candle. When this candle here breaks the high of this candle, that is my go-to to get into this trade. That is my go-to to get into this trade, is on this candle right here. It took out this candle, and there we go, the move started. Now, how do we know if it's going to fail? Well, if it's going to fail, it typically, what we'll see is price will turn back down and go back inside of the box. Now, it can go back out inside the box and consolidate a little more. My personal rule of thumb is if it crosses more than 25% back into the box, I'm out. That's my personal rule. If it starts this candle right here, I got into this trade, and if it rolled back over and went into the box by more than 25% back into the box, then I'm out. But as long as it stays at, this, so if we divide this into quarters here, that would put it, well, maybe, let's see, what do we got here on these lines? 1, 2, 3, 4, 5, 6, 7, 8. So I'm just going to call it this second line right here, roughly speaking. If it dropped below that second line, I'm out. We never particularly know. But this is a measured move. So we have consolidation. We have a high, a low, a 50% move back inside the box. That forms the box. This is now telling us we have consolidation. We see it continues to consolidate over here. And when they break out, first target, a half move, second target, a whole move or a full move, however you want to call it. All right, any questions about any of that? Okay. And we can always come back to questions, of course. So we'd certainly do that as well. Let's move on. Now, Fibonacci's have a very special topic, and because they're so fascinating. Fibonacci actually is a dude. There was a fellow named Fibonacci that he came up with a fascinating series of numbers. And he realized, and we find that this whole Fibonacci sequence, as I'll talk about that a little bit more as we go through it, that Fibonacci's are actually found very much in nature. We find that like seashells, if you've ever picked up a conch seashell there and you put it up to your ear to listen to the ocean and all that kind of stuff, conch shells, things like that. But if you actually look at the swirl patterns on them, many flowers have got a swirl pattern on them, and we actually find out they line up with this whole Fibonacci thing. And so, what is it? Well, Fibonacci's is a sequence of numbers, and it is addition. 1 plus 2 equals 3. 2 plus 3 equals 5. 3 plus 5 equals 8, and so on. So it's the previous two numbers equals the third number. However, that's whole numbers. But this is where it gets weird. If you take 8 and divide it by the next number up, 13, you will get 0.618. And 0.618 is called the golden ratio. Golden ratio. This is another one of these numbers. Just as we find these numbers up here are found in nature, so are these numbers. And that's what's crazy about the whole Fibonacci sequence is not only does the series found in nature, but the division of the series. So if I take 8 and I divide it by 21, I get 0.382. And if I take 8 and I divide it by 34, I get 0.236. And that's where we stop with it as far as that goes. So anyway, so we're talking, there are two bonus numbers that we use. 0.5 is not a true Fibonacci number. There's nothing up here that'll give you 0.5, but it is the halfway mark in a measured move. Just like if we go back a slide, if this was a whole move, there's a half move, 0.5. 0.786 rather is a weird one, and that comes from if you multiply 0.618 times 0.618, you get 0.786. It's just an oddball one, but people still consider it a very common used number. So why do we care about Fibonacci numbers when it comes to trading? And this has to do with algorithmic trading. It has to do with algorithmic trading because computers can do math very easily, very quickly, and sometimes it doesn't make, there's some things that they just don't see as easily. In other words, if I look at this chart right here, and let's just take a look at, let's just take a look right here. And you see that price came back down and was heavily rejected out of there. So the question is, does that number, if the stock is moving along, does a computer is it looking back over here to understand that what's going on there? Well, you see it ended up in a big consolidation area while they tried to decide what to do next. And they tried to push it down and so on. Well, computers can't always understand human behavior on why things work the way they work, but they do understand math. And they understand math extremely well. And let's take a look here. So I want you to see for a moment, I'm going to go back one more slide. What if I took this high and I took this low? Here it is. well, it's not the exact same slide, but the point is here's a low and here is a high. And what if I divided this high and low range by the Fibonacci sequence? 236, 236, 382, 382, 50, okay, 618, and so on. There's the 786. This one actually has got a little bit of an oddball in there of 88.6. You can ignore that. That's just something that the measuring tool had for some weird reason. Let's take a look. Let's follow this along. So here we see we set our high. Here we set our low. Now let's move to the right and let's look and see, did this do anything with Fibonacci's? Right there. Bam. 382. Bam. Look at these two candles right here. Stopped right on 50. These candles stopped on 61.8. Now these candles didn't quite make it, but look what happens here. We're chopping around on the 50. We came back down here. See these two candles right here chopped on the 382. Again, these make for targets. Notice that I'm trading inside the box. I'm trading inside the box. Let's go back. That would be trading inside this box. So I've got my high, I've got my low. So we're now talking about this green, white, these green, blue candles, and so on. We're talking about trading inside this box. We're not talking about the breakout. So all this right in here is what we're talking about. Also, I'm going to come back and explain what these white and blue candles are in just a moment here on my charts here, because if you weren't here last week, you wouldn't know that. Anyway, computers, algorithms, understand math, and they understand Fibonacci's extremely well because it's incredibly easy to program. And look at here's a target right up here to the 786. All right, see this one here started right on, pretty much on close to it, and so on. Again, targets, targets, and targets. So we see a lot of this. As I said, it's weird. We see these kind of numbers up here in nature. And as a result, we also see them in trading. Now, what a lot of people will do is they will do a Fibonacci range on a higher time frame. Let's just pretend for a moment that this is the hourly. Each candle's an hour. And they'll come in here and they'll mark the high and the low and they'll draw the Fibonacci sequence. Then they'll go into the 15-minute and they'll find a high and a low. Not the same ones necessarily, but they'll find in the 15-minute charts a high and a low. And then they'll draw the Fibonacci on that and they'll look for lines that happen to overlap. And they'll say that's stronger evidence of that number being significant. So you can look at stuff like that as well. And that's a strategy. And I know quite a few people that actually just trade pure Fibonacci's. And they do well with it, and that's fine. The beauty of it, like I said, it's all purely mathematical. You've already calculated, just like that pivot point thing before, you know exactly where your targets are. And to some extent, you might even, you might be willing to go long here and catch this. You might, who knows? You just have to kind of develop your own strategy with that to see where you feel the most comfortable. All right. Now, this is trading inside the box. Let's see. I've got a question up here. I understand the box inside after a set of candles have developed. How do you draw and know where to place boxes as candles develop? Okay, so I think we're talking about the box before. I understand the box inside after a set of candles have developed. How do you draw? Okay, so you know what? I meant to do this again. Dadgummit. Let me bring up my my trading trade of 8 here. Give me 1 second. And come on. Hurry up. Come on. I'm going to do this anyway tonight, so I'm going to bring it up regardless. well. All right. Come on. There it goes. There it goes. All right. Let's take a look. Slide this over here. Let's bring all this in. And let me find a spot. You know what? Let me just go to a different ticker. Let's go to the Russell because I don't have anything marked on that. Ooh, looky. I see a box. The question, do you see the box? Oh, I don't have enough time for it. It's not going to work. There's not enough candles to the right. I got to go back. Did you see the box? Here, 50% reset, retrace. Remember when I talked about, you'll know, as you learn patterns, you will just flat out see them in the chart. I'm going to turn this regression off, the squeeze, the volume, and the pivot points and all that. And I am going to talk about my candles in a moment here. All right, here we go. What do I see here? I see a box right here. To here, down here. Okay, now I am going to, now just to keep things easy here, what I'm going to do is I'm going to put a horizontal line on the top of this box so it'll help me keep focus here. Let's take a look. All right, now let's blow it up so you guys can actually see it. I know a lot of times when we stream, you guys can't actually see it because our charts are so small. Let's see what happens. Right here, we come outside of the box. Do I take the first candle out of the box? No. Did this candle break that high? No. So I would have gotten into this trade on this blue candle, me personally, right there. Because we had a chance to run through this, get stopped out, and if that was a liquidity run and blah, 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 and so forth. Now, this is the candle that broke this candle, and it did not come back inside the box first. So now, let's kind of put us a line about halfway in this box. And I'm just kind of eyeballing this. You could actually, no. Let's combine two things. I'm going to use Fibonacci's. Because Fibonacci's have, shoot, I got them set up wrong. Wait, that's the wrong tool then. It's not the one. I've got a custom or community one. Yeah, there we go. Here's 50% right here. And I'm going to zoom in on this. So, let's see. I would have gotten in on this line. It went up and up and up, and here we are in the target box. I'm looking for at least a 50% move, and did we hit it? Right here. 50% move. Right there, it hit it. Then, now we can say, if you're trading just one contract or whatever and you want out of it when you hit 50%, you're done, you're golden, good. If you're keeping a runner, let's say that you've got 3 contracts going and I'm going to take 2 of them at the first target and I'm going to let one of them run so long as it stays above break even. Well, let's see. There we are. Right there. Whole move. Right there. So there we are. So let's kind of go back through that setup one more time. And I'm going to redraw this box, the original box. I had a high. Notice it was a high higher than all this. I had a high right there on this candle. And I got a low on this candle. So I got a high, I've got a low, and then we moved at least halfway back into the box. There's the box. Done. Now, some could argue that this candle is not the best candidate because this was a whip. Well, I mean, not a whip, but just a very quick tick. And that's fine. If you don't like that, you would set to this candle and ignore this one. Because it was just a whip down and then right back up. So you could set your box based on this one here. And again, this high took out a bunch of highs. This low took out a bunch of lows. And then we've got to move 50% back in. So if we did that, so we're going to control double click to copy that box. And, oh, wait, no, we were using the Fibonacci. Let me get rid of this and we'll redraw it using this Fibonacci tool. Right there, 50%. Now, the downside of this particular trade is we will notice, well, we didn't actually quite, we were one tick away from it. Again, I'll blow it up so you guys can see it. We came real close right here, one tick. We didn't hit it, but we did over here. We did over here. And as you can also see, ultimately in time, we did hit a full move. And we never left and came back out of this box. We never came back 25% into this box. So I'm still in this trade. If I'm using a runner, that last contract, I'd set my stop at break even and I just walk away with my target, take profit up here, my break even at my entry, or, you know, maybe one tick there to cover commissions and walk away, come back. So I would have gotten into this trade at, okay, 4:25 in the morning, and I wouldn't have gotten fully out of the trade until 8. So this was practically a 4-hour trade, but you could do that, whatever. At any rate. All right, any other questions about the box? Okay. Now, just like we can use Fibonacci's inside of the box, we can use them on the outside of the box. As a matter of fact, that's what we did over here, didn't we? Here's the 0. Let me blow this. Come here, you. Here's the 0. Here's the 100, roughly in my box. I'm off just a little bit, but still. So, wait a minute, where'd it go? Oh, I'm on two different, I'm looking at two different things here. Duh. Let's take a look at that again. Matter of fact, let me actually redraw that. Oops, I'm going the wrong way. Well, dadgummit, I'm still doing this wrong. I'm trying to go, so it's got to go from the bottom. One more time. Here we go. This way, from the bottom of this box to the top of the first box. Let me come over here so I get my lines. So you see I've got the 1, I've got the 0, and then these are extensions. Now they're negative. Don't worry about the fact they're negative. 23.6% above the top is the same thing as 23.6 if I were going bottom. So it doesn't matter if they're positive or negative. But the point being is that this is called a Fibonacci extension because we took the range and we are extending outside of it to project the future kind of thing. You know, or possible targets. It's not really projecting the future. That's really a bad term there. But we are saying, well, what are the targets? So based on this range, give me the Fibonacci sequence outside of the box. And here they are. 50%, which we did hit, and 100%, which we did hit over here 4 hours later. So here I'm showing it. Here's a range. Here's a box, a low, a high, a move 50% back inside of it. There is your box. The Fibonacci extension says instead of measuring inside, give me the ratios outside. And here we are. Where's that 50% line? Right there. Took it out. Did we make 100%? Which would have been this line up here. And the answer is close, but no. So I mentioned earlier the odds of hitting the 50% are much, much higher than the 100. So just always kind of bear in mind that if you're going to use these box ideas, your main target is 50% of the move with, and if you leave a runner on for the 100% of the move, that's fine. Now, when we look at these Fibonacci's and we look at the box, there's one thing to keep in mind. You got to keep this in mind. Let's go back. Let's just talk about this box. The same thing. All three of these slides are all related, aren't they? The box has got to be tall enough so that when you get into this trade, there is enough price for you to get to target and make it worth it. In other words, let's just take a look at this here. All right, now the Russell trades like the ES. It's instead of quarters, though, it goes by tenths, but a point is 5 if you're on the micros or 50 or if you're on the minis. So let's see, was there enough profit in this trade here to get to 50%? Because I wouldn't have gotten into this trade until here at 2066. I'm just looking over to the far right. To 2069. All right, roughly. So that's 3 points. There's only 3 points in that trade. If that's not enough for you, for your type of trading style, the box is not big enough and you've got to wait for a bigger box. So just kind of keep those kind of things in mind. If the box is too big for you, that's fine, because, if you have to have the patience and maybe the account and so forth like that or whatever. Just make sure that you find a box that is big enough that as you move, that, if you're going for that 50% target, there's enough money in it in the first place, because you don't want to get stopped out. That for if you're looking to make $100 on a trade, well, this is 3 points and you're on the ES, that's no problem. There's $150 in that trade. Okay, that's fine. But if you're looking to make $200 on a trade on average with one contract, this box is not big enough. If you're on the the micros, instead of $200, it'd be $20, but the same concept. So always check to make sure that, I see a box. Well, is the box big enough? And that's fine. So just kind of keep that in mind also. Any questions there before we move on to our last slide, before we go do some chart hunting? All right, Kevin is talking to me now. Teacher, I see you, teacher. You're not hiding. You can't get by me. I see you. You're giving me a grade, aren't you? You're giving me a grade, and I know you're going to be mean on me because you're a mean guy. He's tough. I'm going to tell you what. Oh, Lord. Okay. He's not in the stream, actually. He's traveling. He's just reposting. Okay, yeah, I forgot. He's not in the stream, actually. But anyway, so he didn't hear me. Oh, well. Maybe he'll hear me in the replay. Love you, Kevin. Dude. All right. Let's move on. Any more questions now before I move on? Okay. So our last topic before we get into slides, chart kind of thing tonight, is about liquidity runs. This is a big, big thing. Very big. It is something that what I want you to see is this. This is where people get stopped out all the time. This is where your trades get just wrecked. You've got to learn to expect a liquidity run. Here, price is choppity. Finally, the move breaks out and it goes to the north. Now, anybody that went long here, where's their stop? Well, it's just underneath where they went into their trade, right? They don't have their stop way down here. They may initially, but once they see the trade is working, they put their stop right here, roughly at their break, where they got into the trade area. You know, even if they got in up here, their stop would be down here because that's where the line seems to be. Okay. So price trades, and then price turns around. Why do we see this big hammering candle down here? What's going on with that? That is because there's all these people that went long here. They all went long in here, so all their stops are sitting down here. Well, the institutions, they want to go long. They want to go long. They got up to here. My mouse keeps timing out and going to sleep here. Let's see. They got up to here and they started shorting it. Now they want to go long again. But in order to go long again, what they really want to do, is they need the orders. They need the orders to do it. They need the volume and the orders and so forth. So who's the most likely target? All these orders stacked right here. There's a pile of orders sitting right here. Well, they come down. Now, what are all these orders here? These orders are, since they went long, these would be stops. They would be doing what? Selling. So they come down here and they trigger all these sellers down here and they buy from them. They buy all these sellers out down here so that they can do what? Go back up here. And then look what happens. See these highs right here? See that tiny little wick right there? I kind of should have zoomed in maybe a little bit more on this chart, but you can see that little wick. They ran up there because all these people here are wanting to, they went short. So if they're short, to get out of their trade, they have to buy to close their trade. So they go up here and they buy all these people's orders. And so it comes over here and then wham, down here it goes. And that was the moves they took. Notice the phrase I'm getting ready to use. They took liquidity. And whap, down it goes. Now they cashed out here, it went back up here. We had a little whipsaw action going on. But notice right here, this is probably a news candle that caused the market to go up and down and everything. But, so what do we see right here? Stop orders. Where's another place there's a bunch of stop orders? Probably right here. Yeah, wouldn't you agree? So here's some stop orders. Here's a bunch of stop orders. All these people with stop orders down here are going long. And it did. And then eventually it came back down. And we'll see a tiny little wick right there. See it? What did they do? They took all these people's stops out here so they could bounce and go back up here. Now, what's so important about liquidity is understanding that it just goes down for a second. This is not going to go down and then down and down. They're not coming down and down and down and down and down. No, they're just coming down here just long enough to stop all these people out, close and all these people get out of their orders. They now get into new orders using these people's orders here so they can go the other way. Which is why I do not go long on this candle, because that could be liquidity run. That could be a liquidity run. I want to see that then I want to wait for the next candle to break So now that this is a liquidity run, they've had time to take all the orders they want to see if they're going to go back south. Well, they didn't go south. They went north. So this was not a liquidity run, but I don't know that until a candle breaks it either way. I don't know if this is a liquidity run until a candle either breaks up or breaks down below this candle. I don't know, which is why I'm going to wait till this next candle. When this second candle breaks the first candle, I know that that wasn't a liquidity run. That was just whatever. We say, well, back here on this box business, what happens if it does go up here and then it comes back and starts chopping around in here? Then I make the box bigger because this becomes the new high. Well, what if it comes down here and it goes down the bottom, but it comes back inside the box to about the 50% area? Then I lower the bottom of the box to the new low. I want to see, it, as far as do I change the size of my box, I want to see that candle. If this is liquidity run or whatever, or it's not ready to break out yet, if this candle rolls back in and hits about the 50% level of the box, then I know I'm just simply making the box bigger because this is now the new high, not this one. I just make the box bigger to the new high. And wait for the breakout, in which case, if I'd made the box bigger to this one, that would be your liquidity check. This would have been your breakout kind of thing. But in this case here, we have our liquidity check, we have our breakout, we're in the trade, and off we go. Questions about any of that? Okay, now let's just talk one last little thing about this liquidity, and then we'll go look at some charts real quick. Liquidity runs are quick. They go down there, they grab them, and they move on. A lot of people have been trained, to treat these as breakouts. And they say the minute that this candle breaks the low of this candle, a lot of people were trained that that's a breakout to the south. Well, it can be. It can be. But don't take it on that candle. Wait for a confirmation candle, the next candle. It can be, but you wait for the confirmation candle. Let's see. Let's take a look here. Have we got any here? Kind of looking in here. I know this is hard for you guys to see, but there are two little wicks right up here at the top. And we say, well, let's draw this line over to here. Do I get in this trade now? Do I get into this trade? Because I can draw a box here. And the answer is on the second candle that breaks the box. That's what we're looking for. We look for confirmation. So, all right, that's all the regular slides for tonight. Before we go look at some charts, does anybody have any quick questions about anything? Now, I noticed over in the Discord chat, would probably have gone long here, but I just started here Monday. So let's take a look at and just to I'm gonna bring this out. No, actually what? Okay, I see what he did. Let's go back and look at that. So somebody said I would have taken the trade right here and gone north. And you ask yourself, let's see, where's my little tools? Pen. Because we see this now, this is something, oh, I see what you're saying. You're seeing this doji candle. We will be talking about this next week. What he's saying is he saw a doji here, I believe, I'm interpreting I'm guessing, and he would have gone long because of that. And you can. That's the same thing as trading inside the box. That's just trading inside the box. You can trade the Fibonacci's inside the box, and if it gets outside of the box, then you go to the extensions where you're going outside of the box, and that's fine. Again, everybody's got a different trading strategy, and that's cool. There's nothing right or wrong with any of that. It's a question of, again, like I say, when you look at a chart, what do you see? All right. If we last chance for questions, or we'll go look at some charts real quick, and then we'll wind this down. For a day trader, let's see, what time frame do you look for liquidity grabs? And for a day trader, what is or are the best time frames to look for identifying liquidity grabs? 1 hour, 2 hours, and so on. All right, liquidity grabs. Where are you? Here. Let me clear this chart. A liquidity grab you can spot it. Let's start at the hour. Now, what does a liquidity grab look like? Well, so I'm going to put this here. And what I'm going to do, because remember, a liquidity grab is quick. Bam, bam. So you will see it. But remember, when I'm on the 1 hour, the candles represent a lot of 5 minute. There's 12 5-minute candles inside this one green candle. So it depends on the time frame that you are trading. So let's take a look at, actually let's go, yeah, let's take this top. So I've marked this high. A 5-minute candle. There's 12 5-minute candles. One of those 5-minute candles took this out. One of those 60 1-minute candles took this out. So just so I can make sure that I can find this, I'm going to put a vertical line here just as a reference point. And let's go down onto the slower time frames. Let's go down to the 15. Where are you? There you are. There. There it is. If you trade the 15, there it is. Let's go down to the 5. There it is. Again, notice it's a skinny wick. Bam, went up, came back down. It didn't hang around up there. It nailed it, got the orders, and it's out. Let's go to the 1 minute. I got to find it. Give me a minute. There it is. Here it is, 1 minute. Look how skinny that candle is. Look at that tiny little wick. Bam. It didn't hang around up there. It just did it. Let's go to the 15-second. By the way, this is at 9:35 a.m. my time. Let's go to Jeremy's favorite seconds. 5 seconds. Hang on, I got to get there. Come on. Well, am I in the right day? I think I'm in the wrong day. There it is. 5-second chart. Five seconds. 1 Mississippi, 2 Mississippi, 3, whatever. Okay, you get the idea. We came up here. We were in this area for a total of 20 seconds. And then we were out. That's how long as it took. It took them approximately 20 seconds to get all the orders that they needed to start their bear run. Okay, the question was asked about the candles. Anyway, so as far as the liquidity goes, it's a quick whip. They're in, they get the orders, they're out. and they start their run the other way. They get set up for your attack run there, Luke. But anyway, and then there you go. There they go. This, again, is why you wait for confirmation. Now, you could say, well, am I supposed to go long here? That's 5 seconds, man. Come on. Give them a little bit of time to do their thing. I wouldn't, do it on anything less than a minute. The question is, I meant to do this earlier. I meant to do it at the very beginning. Question is, what do my candles mean? Colors. Let's take a look at that very quickly. I have standard red and green candles, but you'll notice I also have blues and whites. This blue candle, notice that this blue candle took out the high of that green candle. Notice that this blue candle also took out the low of that green candle. This blue candle we call engulfing candle. We also call it an outside candle. Now, what does that mean? What is outside candle and all that? Well, first of all, before I get to that, let's talk about this white candle right beside it. And notice that this white candle did not take out the blue candle's high. And also notice that the white candle's low did not take out the blue candle's low. So this white candle is inside the previous candle. So this blue candle went outside of the previous candle. This white candle is inside the previous candle. Now, notice here that they have the same top. He didn't break it. This white candle did not break the top, so it's still an inside candle. Now, what's the significance of this? Well, inside candles tell us for the brief moment in time, we're not sure where we're going. We don't know if we're going up or we're going down. The institutions haven't quite decided yet which way they want to go. So for a brief moment, there's indecision. On the other hand, blue candles said that somebody, one institution threw a lot of money to the north and another institution threw a lot of money to the south. And this tells you that they are trying to move it, and they both have an agenda, but they were not in sync. If they're in sync, this is we're in sync candle. Everybody's on the same, we're all going short here. This is, we don't know if one group's trying to go long and one group's trying to go short, and it's not resolved yet who's going to be the stronger, right? Now, what can you do with this candle here? Well, one of the things you can do is clear these drawings. One of the things that you can do possibly is this to here. Make that array. And then here. Make that array. And we call this a broadening formation. Now, it doesn't look like it's going to do much here, but it kind of gives you that if the price was going up, this would kind of be the angle that it's going up. Now, obviously, we can see that it's not. It's not going anywhere. But, of course, I'm on a 5-second chart, and there's 10 gazillion candles as a result. But let's try it on a higher time frame. Let's go to the 5-minute chart. Maybe we can get some action over here. I'm just going to pick this one. I'm cherry picking, I know. But this is called a broadening formation. Oops, wait a minute. There. And then down here, and maybe we'll get lucky. I don't know. I have not looked at this chart to see if we're going to get lucky with these broadening formations at all. Yeah, no, we're not. Let's go to the higher time frames. Let's go to the hours just so we can consolidate some of these candles and see. Well, that's cute. That didn't work at all. All right, well, that was a failed experiment, but you get the idea. The idea, though, here is that you're kind of getting an angle of the direction that it could go. So let's see. All right. I'm looking in the chat here. Oh, you know what? I got this thing on top chat. Let me make sure I put it on live chat and review this to make sure I did not miss anybody's question. What time frame? We talked about liquidity. We talked about best time frames for that. Candle colors and so on. Let me look over here. And so, okay, bullish bears is good. All right, any more questions as we wrap it up here? Again, I'm a little over time on that. I apologize. Looks like we're going to be about the same place as we were last week because I was about an hour and 10 last week also. But I'll certainly be glad to take if anybody's got any last minute questions. And following this, I'll take a break for a few minutes, and then I'm going to pop back over to the Bullish Bears Discord. And if you're a visitor here, glad to have had you. I hope you learned something. Well, I hope everybody learned something. But the Bullish Bears, like I say, I'm just a member. I'm just a member of the Bullish Bears. I do this because I enjoy teaching. I'm not compensated in any way for this, so I want you to understand that I pay to be a member of Bullish Bears, and I'm going to tell you, as somebody that has been in probably a dozen different trading services over the years, this is by far the best. Why? Because they're honest, they're legit. You get to watch them trade live. You get to actually see if they win, if they lose. I'll give you a hint, they win more often. They definitely win more often. So if you're looking for a group community to join, you could certainly come in maybe just on a 1 month just to see if you like the group. We'd certainly be glad to have you. I get nothing. I have no affiliate links or anything like that. I get nothing out of if you join or not. I just think it's a good group of people, and I'm very happy to be with them. So, at any rate, and you can find them at bullishbears.com. And, well, I guess there'll be a link also in the YouTube descriptive. Beyond that, I'm not seeing any more questions on either side. So, other than Jeremy's typing to me. What did I say wrong, Jeremy? Okay, gush. And do I trade ES or NQ? I have noticed NQ moves are more fluid. Okay, so this is a great question. You trade a ticker that moves at a comfortable speed for you. I do not trade the NQ. It is too fast for me. I will trade the ES. I'll trade MES, which is the micro. Some days, if I think there's going to be a lot of craziness, I'll go to the micros. If it's a regular day, I may trade just the ES, and that's fine. Actually, a lot of days, I will trade crude oil, CL. And you say, why would you trade crude oil? Because it's smoother. It doesn't, news candles don't come out and throw it all over the place. Some people love choppiness. I know Jeremy loves choppiness, and he's right at home when the chop is there. Jeremy is he's singing and smiling and everything like that. I, on the other hand, just sit there and stare at it and wait, and it doesn't come. And I sit there and maybe I get impatient and I take a trade that goes against me on these choppy days. And then I realize I'm not trading this today. And so I get out and walk away, which is one of the reasons I personally like crude oil, CL. But you are going to find, quite frankly, and I'm just making up a number, but I'm going to say probably 75% of the people out there are going to trade either ES or NQ that are day trading, that are active day traders. And you say, well, why? Well, because it's very liquid. It does have a lot of movement throughout the day, both of them, ES and NQ. They, of course, there's tons of news. There's tons of other things that you can put up, like, if you want to use the VIX as a comparative, as an indicator to a counter kind of thing, if you know about the VIX. You have that kind of stuff for the NQ and the ES, even the Russell, the RTY. But for me, I like crude oil because it's smoother. But that's being the case, though, that if I come in and Jeremy's trading the ES today, I'll probably trade the ES with him. Why? Because that's what he's talking about. And, so I'm on the same page. So I'll trade what, a lot of times what the group's doing. Now, if Kevin is in and Kevin likes the NASDAQ, the NQs, I know that the NQs and the ES are always about 97% identical. So you can trade the ES along with, while Kevin's trading the NASDAQ. Kevin's perfectly at home in the NASDAQ. Jeremy's perfectly at home in the ES. He can trade the NASDAQ as well. I can't trade the NASDAQ. It moves too fast for me. You have to look around and just try a few things. That's one of the beauties of paper trading. Paper trading, I'll throw that back out there again. Paper trading, because as you're learning the personality of a ticker, notice what I said, the personality. Tickers have personalities. They have ways the news moves the ES and the NQ around all over the place. There's far less news on different other things, but they all have their personalities, and you need to kind of learn that, just like people have personalities. So, at any rate, I hope that answers your questions. Let's see what strategies you use for trading using price action, like risk to reward. I go by targets. I'm going to go by a target. Now, obviously, when I'm looking at a trade, the most narrow thing I'm going to do is a 1-for-1. And so when I'm looking at a trade, let's just take a very quick look here. Let's use a box. Oh, no, not the correct high. Let's go here. And let's here. Okay, now let's make this bigger. Remember I talked about 25% in the box. Well, 25%, if this moves back inside the box, at least 25%, which is pretty close to 23, I'm out. If it drops below this line, I'm out. So I look at this here and I say, well, what is this range? Well, this range, we're on the Russell, so that's going to be $50 a point. If you're on the Russell, if you're on the M2K, which is the micro, that'll be $5 a point. So that's 2071 to 2079. 2071 to 2079 is 8. 8 times 5. Let's say I'm trading the micros. 8 times 5 is going to be 40. What is my acceptable loss? Well, if my acceptable loss is less than 40, I'm not trading this. I'm not trading this because my risk, for one thing, is greater than what I'm willing to take. I'm not willing to take a loss bigger than that $40 or 400 if we were on the other. But you say, well, but you got this beautiful target, and of course we actually did hit the target. But you say you got this beautiful target up here, but am I going to have to risk too much to get to that? I would love to get a 1-for-1. I would absolutely love to get a 1-for-1. I'd love to get in The other thing too is, well, where do I get into this trade? Because you see, we got this big blue candle, and which meant I would have gotten into this trade. Let me open this up so I can get the tick. Right here on that green candle, because that's when this green candle broke this blue one. But notice how close. I'm already 15, 20% into the box. I'm too far into the box. If the break would have occurred back here, well, that would have made a lot of sense. This is a bad trade because now my risk is from where I got in back to back way back here, and my risk now back here is far greater than my target here. That's a bad trade. I would not take that trade because that blue candle just blew everything way out of the water because it overshot too much. Had that blue candle had stopped right about here, including the wick, and then this green one took that out, that'd been a different story. But, you know, like I said, this is not a good trade because I'm already almost 20% into my target area, and I'm only going to 50. Now, did it hit? Yeah, it hit. But I don't know that because that would be in the future. All I know is at one point in time, this candle went to right about here, and I would have said, well, I'm in the trade. And if I'd been in the trade, yeah, I would have hit target. But my reward was far greater than my risk. So to answer your question is, first of all, you have to say, how much am I willing to risk on a trade? There's what we call our max loss per trade, and then your max loss per day, if you add up all your losing trades. And so I need to make sure that that at least at minimum, I'm going to get 100 1 for 1 of my trade. If my stop, let's say, is just making up some numbers, if my stop is 15 points, I need to make 15 points in my target up here for a 1-to-1. Ideally, I'd like to get a 2-to-1, which would be up here kind of thing. But so it is kind of dynamic. It is kind of dynamic. But what is you have to ask yourself, you have to figure it out, what is your risk tolerance on a trade? And that's just everybody's personal thing. Some people say they're only willing to risk 2% of their total account on any trade, 2%. They can have multiple trades on, but no trade, the loss can be more than 2% of their account. And which is fine if you got a larger account. Now, if you've got a real small account, it's hard, right? It's really kind of hard to say, well, I can only lose 20 cents. Well, okay, then we may have to make some allowances there. But, if you've got a $200 account, it's hard to say that, you're only risking 2 to 3%. But anyway, all right, folks, I need to wrap this up because we are kind of over time now. And like I said, I'm going to go over to the Bullish Bears Discord group after a little break, and be glad to take some questions over there for anybody that has some. I hope you've gotten more out of this. Hope you've enjoyed it. And we will see you next Tuesday for part 3 of the series. We're going to talk about candlestick patterns and stuff like that. I can't think of it right now. So, anyway, folks, I hope y'all have a good evening, and we will see y'all around. So let's see, and I wish everybody a good night.